We hold the people that lead that business in very high regard.
Expect the stock picking, market timing, active ETFs to come hard with the marketing.
You could eliminate 10 years worth of that saving just by getting caught on the wrong side of a trade.
Welcome to What's the Risk, hosted by myself, Daniel Crowe, and Peter Mansell, founder of Mansell Financial Group, a financial advice business he founded in 1980. This is a simple video series we hope investors can use to better understand index and portfolio performance, along with addressing some investment questions and dilemmas. This episode is on the never-ending stream of ETFs and the dilemma it poses for investors. We're going to touch on Avantis towards the back end, but we're going to look at various considerations, and as we have an investment committee, just highlight some of the things our investment committee considers before adding something to our approved product list. Now, we're pretty strict, and about 99.9% of the time we rebuff approaches from fund managers on philosophical grounds, but we'd be foolish not to consider Avantis, and we'll look at some of the reasons towards the back end. So, Your Investment Philosophy, a book we wrote, available at Amazon. Disclaimer, please pause and read. Suffice to say, our intent is educational and not rendering financial advice. So more and more options. ETFs are coming thick and fast, and more choice isn't necessarily a good thing because you don't have to own every ETF on the market. And in 5 years' time, how many of these ETFs that have been launched that over the last financial year, 49, I wonder how many are actually going to end up abandoned and closed. So the question is, if you've already built your portfolio, what do you do if something else pops up that may better fit your needs? And in a sea of rubbish, there occasionally will be better products. And the other thing is there's more active ETFs on the market now too. They have to be marked as active for regulatory reasons, but there's also various categories of active. Now, there's active funds like Avantis and DFA, but there's also indices with rules that screen for things like value and quality too, which some may argue are similar to Avantis and DFA. And then there's full-blown stock pickers that are now appearing with ETFs via dual access managed funds, Peter.
Yeah, I think it's valid to say that there is active and active. There are active processes that target factors that we know have delivered higher long-term returns for investors, and there are active investors that might believe in market timing, stock selection, horoscopes, magic, and the like. My own view is, honed over a very long period of time, I'm happy to back active factor-based investing. People that want to make predictions, make forecasts, believe they can pick the next winners. I wish them good luck, but they won't be seeing any of our clients' money.
And just a warning on those active ETFs. You can expect the stock picking, market timing, active ETFs to come hard with the marketing to attract ETF investors now. And I've listed some of the common terminology that they always use to try and convince people to invest with them. It's the same old stuff. It never changes. And one of the big ones, well, we've just got to get active. They usually come out with these things towards the end of the year and the beginning of the new year as well. So you got to get active. Conditions have changed. You need a judicious manager. Indexing's lazy. You got to protect against the downside. You'll go down with the market. Active managers to shine in 2026, 2027. You know, you'll need to get active to stay ahead of the pack. But one of the big ones that we look back is guiding you through volatility. But COVID was one of those examples, and if we look at the SPIVA from 2020, it shows they really did no better than usual, Peter.
The chances of superior performance prove to be very, very poor. This same chart gets produced year in, year out. I can assure viewers that if we were looking at 2021, 2, 3, 4, or even the most recent ones, the 15-year numbers are still just plain awful.
And the other one is lower fees. Now, this is more aimed at new index ETFs and flagship ETFs trying to capture attention in a very crowded market. The most obvious way is to do it with lower fees. Now, fees certainly matter, but at some point you need to ask, will you see that slight fee adjustment show up in your portfolio? And you do need to assess a lot of other things there: fees, taxes, implementation, and whether this ETF fits in your portfolio. So it's finding the most robust solution for your needs, not just trying to knock off 3 basis points.
100%. Firstly, if you've got a 3 basis point saving or even a 5 basis point saving, you could eliminate 10 years worth of that saving just by getting caught on the wrong side of a trade on the day that you move. Secondly, if there's any tax liability to be paid, knowing that capital gains are taxed, concessionally at 50% or even only a third for a super fund, rather than, income generated by investment assets, that cost saving can be leaving the investor in a position that they're behind for a long time. So, if you're going to change for fees reductions, make sure you assess how many years it's going to take you to get that back.
Now, we're not going to labour these too much, but we just want to highlight what you might look for. And this is in Australia, and this has been an example where a newer ETF, DACE, has improved performance, and investors have seen slightly less tax drag in comparison to a flagship ETF. It also offers broader diversification, which is something that you don't often find in Australian ETFs because they focus on the larger stocks in their flagships. What is the explanation for improved performance? Well, it's probably the tilt to small and value and use of profitability. And one example is it's been underweight CBA as the valuation really got out there. So when CBA fell, it obviously didn't get dragged down as much.
Absolutely. Look, obviously these two portfolios are constructed in different ways. And when you look at the top 1/3 of the table, you look at the Dimensional Australian Core Equity Trust. Yeah, the result's superior by 70 basis points. That's a meaningful difference. That's great. On an after-tax basis, that gap gets out to 91 basis points. And if you look at a high tax rate payer, there's still an 83 points difference there. But that doesn't mean the dimensional way has to be better than the VAS way in the longer run. And indeed, if we look at other parts of the global equity market, the results will soon show they can be different. But it is important for investors to understand why a particular portfolio is managed in a way that will deliver a better tax outcome. And certainly, an index fund will tend to be invested in a tax unaware manner. I know from personal experience and understanding that the Dimensional Australian Core Equity Fund is managed in an extremely tax-aware manner. I know that particular portfolio over a very long period of time has distributed almost no realised capital gains. So tax drag, damn important, especially for anyone that pays any tax.
And globally, on the flip side, having more small and value hasn't worked as well for investors in recent years, but DGCE has seen less tax drag versus a flagship global ETF. And while that's not a like-for-like comparison, as Peter said, with the Australian fund, if an investor was pursuing a similar factor strategy, potentially using 3 ETFs to try and do what DGCE is doing, they would likely see even more tax drag than DGCE. And I'll sort of reference my own experience later.
This is a great flip side to the previous chart, because here the index fund has delivered a superior result over that same 10-year period, and that's largely been driven by global growth stocks. Have had an incredible last 5 years, and as a result, there's 164 basis points in the bank with the index fund. When we look at the mid-tax outcome, the 164 points drops to 137, and for a high taxpayer, it drops to 134. Tax has to be considered, and funds or ETFs that manage the tax outcomes actively and very deliberately, they can put money in investors' pockets, that's for sure.
Global hedging. Again, similar points to the prior side with smaller value, but with hedging. And the tax drag in one instance, which is I found interesting, has eliminated the performance difference. Now, it's obviously hard to know if this is just timing and will it continue. It is also a more broadly diversified hedged factor solution, eliminating the need to combine multiple hedged ETFs.
Hedging, should only be used by investors who want that additional protection in their portfolios against, big swings in the currency. The cost of hedging definitely needs to be taken into account. It can sometimes lead to extended periods where the particular ETF or fund might not pay, income distributions. But I've equally seen times where suddenly the hedging absolutely pays off, and there can be some quite large distributions in the form of income.
I think one of the interesting things I found back in 2021, when there was those big swings during COVID, iShares hedged S&P 500 spat out about 17% of the value of the fund in a distribution.
When there are big currency swings, the hedging contracts, which are really like an insurance policy, they can have very large claims that have to be paid out.
Bringing us to Avantis, they have 3 new ETFs in Australia: a global developed option, a global small cap value, and emerging markets. So more will be coming. So you've heard, Peter, but to investors, do you just jump in? I guess we'll just briefly touch on things our investment committee asks. So
Cool.
Our investment committee would have a fund manager presentation and discussion. After that, well, you probably know beforehand that the investment philosophy, whether there's an alignment with Avantis and our current approach. And
Sure.
The question there is, if you don't have an investment philosophy, how do you know if a product is right for you?
Absolutely. This is a very, very critical point. Yes, they've launched a few products here in Australia just recently. We hold the people that lead that business in very high regard. We know that their philosophical beliefs align with ours. But, to an investor that's seeing their name appear for the first time, how do you know if they're right for you? If you don't have an investment philosophy at all, how do you know that their investment philosophy is going to suit you? We know that their philosophical beliefs and ours are aligned, so we are taking their arrival into Australia very seriously, considering them seriously, and digging very, very deeply to understand the differences, the similarities, the nuances. And we've had a number of presentations by them, sent back Q&As for them to give us additional information. We've now got sufficient information that we are going to look at how they could be included within our model portfolios and how we would need to tweak those models with the inclusion of their offerings as opposed to the incumbents. It's not something that you take lightly. There's a lot of work involved, and as the slide points out, not many investors will go to that sort of trouble. As an investment committee, we have a responsibility to do that for every client that we serve, and we do. It's a big job, it's an essential job, and it can lead to better outcomes. Our investment committee has made tweaks and changes to our model portfolios over the last 25 years, and we can look back and say that our portfolios today that we build are better than they were 25 years ago. There's been little incremental changes along the way that have resulted from a lot of hard work, a lot of due diligence and deep analysis, and certainly that's happening again in the case of Avantis today.
When our investment committee gets deep into the woods, there's things that they need to consider, and it's obviously looking at how Avantis may do things differently to the obvious competitor, being Dimensional. And while they are similar overall, they do have some differences. And I just pulled out a few things that have been noted by our investment committee. And, there's various differences, whether they use cash flow profitability or operating profitability. There's different weighting mechanisms. And there's other things with the tax structure that these funds are going to use, with the consideration of accumulation ETFs. Clearly, there will be benefits, but there will also be considerations of whether there'll be ATO scrutiny at some point that you've got to consider.
Absolutely. If we just take the first point that you touched on, cash flow profitability, we know, from the work of Robert Novi Marks years ago, that companies that are highly profitable will eventually deliver higher returns for the shareholders. Now, intuitively, that makes sense, but how do you measure profitability? If you use accounting principles that take into account invoicing or revenue that you expect to collect because you build it but you don't have it yet, that can sometimes prove problematic when the revenue actually doesn't arrive, it's referred to as accrual accounting. Now, Avantis say, no, we just discount accruals across the board because you don't actually have the money yet. Now, my own personal human bias says I actually believe in that, and our own companies operate on what's called a cash basis. We don't measure accrued income. We only measure income when it's actually arrived. When you look at the tax structure, Avantis are going to use a usage structure that won't distribute income as the investor holds it. That has particularly good advantage because realised capital gains here in Australia are only 50% taxed or 1/3 taxed in the hands of a super fund. Now, it's a completely legitimate structure that's been signed off at various levels of government and at the ATO at present, but over the years, I've noticed that tax arbitrages can sometimes meet ATO scrutiny unfavourably. Now, if that happens, that advantage could be lost. So we don't want to get too excited about that because we have an awareness that it may be short-lived. So we've got to look for what the long-term reasons are that the investors should use the Avantis funds, not the short-term advantage that might be eroded away through a flick of a switch by the ATO or the stroke of a pen by someone in government.
Yeah, there's tax things that the fund can do, but I guess when you're relying on a ruling from the ATO, that's a different tax consideration, isn't it?
And history is littered with ATO rulings that change the ATO's position.
Mm. And questions your investment committee asks, being the viewer. So generally, do you need it? If you already have a portfolio of ETFs that fits your needs, why change? Now, if they genuinely fill a gap that you have in your portfolio or offer better implementation, that's definitely a reason. I'll just bring up my own situation here. I use VGS, VVLU, and VISM. Been doing that for some time now, but globally, DGCE has come along, and now I'm faced with the obvious. They perform very. I've done some comparisons, and the weightings, having them on the similar weightings, is a similar performance. But when you look at the tax, I'm probably paying much more in tax with what I'm doing. So it comes down to a personal decision, but I'm kind of comfortable with what I'm doing. So I don't know really how do I change, because I'd have to move to another platform to start up with DGCE. So it's really frustrating from that position, Peter.
Oh, well, there's a couple of key points there. Firstly, if what an investor is doing, it's not broken now, and if it's based on the fundamentals of efficient markets, risk and reward being understood by the investor, broad diversification, which VGS, VVLU, and VISM are. If the asset allocation that underpins your holdings is an asset allocation that you're comfortable with and is correctly built to target your needs, and you stay disciplined, which you can with those ETFs that you mentioned, there's actually nothing wrong with that. So to decide to change, there better be some very good reasons. If it's a fee difference of less than 0.1%, well, I just ask you to think again, because it's probably not enough reason to change. If the underlying portfolio construction has good fundamentals as to why it should deliver a higher return, by all means consider it. If the new structure would likely give you a much better tax outcome in the longer run, yeah, by all means consider it. But the first thing to start with is, does the portfolio actually fit our 5 key fundamentals of market efficiency, risk and reward, diversification, asset allocation, and discipline? And then next, if it's not broken, don't try and fix it.
Yeah, and the final points there, if you're going in a different direction, that's fine, probably. Maybe if you're moving away from indexing and you're moving to maybe factor-based investing, but changing like for like ETFs on fees when it's a small number, it could get eaten up pretty quickly by a lot of other things. So you may not even see those small differences. So you've got to look in other areas to make sure that overall it's the right decision.
I think if to the point of if you're going in a different direction, make sure that you understand whether you've had a change of philosophy or whether it's just a fad.
We've put this chart up similarly before. There's a lot of genuine investment products out there, but there's only ever going to be a small amount that meet your needs. So you have to find those.
In aggregate across all of our clients, we use a very tight number of investment products that we know achieve those 5 key principles that I described earlier, which means there are thousands that we leave on the shelf that we don't use. Why? We don't need them. Our clients don't need them. We don't need the complexity of having to use them.
And sources and descriptions of data. So thanks for your time.
Bye for now.